Walk down any British high street and something feels different. Not obviously broken, but shifting. The Poundland that has been there for 15 years has clearance signs in the window. The supermarket car park that used to be packed on Saturdays is half empty. Delivery vans from German discounters arrive in neighborhoods where they never used to go. Start with Asda, Britain's third largest supermarket, the one with the green logo and the promise of saving money. On the surface, it is still there, still functioning, still selling groceries to millions of people every week. But underneath, something has fundamentally broken. Asda carries £5.7 billion in debt. Not 5 million. Not 500 million. £5.7 billion. That debt costs roughly £750 million a year, just in interest payments. £750 million that never touches a shelf, never pays a worker, never improves a store. It exists only to service debt. This did not happen by accident. In 2021, two billionaire brothers and a private equity firm bought Asda from Walmart in a £6.8 billion leveraged buyout. They borrowed against the company's assets to pay for the company itself, a maneuver that was legal, common, and left Asda struggling to breathe. Things worsened. While Tesco, Sainsbury's, and the discounters posted growth, Asda's sales fell 6.5% in the 4 weeks to December 27th. The only major supermarket to lose ground during the most profitable shopping period of the year. Bond prices fell again. Financial reports began using the phrase, distressed debt. Asda has not filed for bankruptcy, not yet, but the trajectory is unmistakable. The company sold 30 supermarkets and a distribution depot for £568 million just to pay down debt, then leased those same properties back, increasing its rent burden, selling assets to survive while competitors invest in growth. The question is not whether Asda collapses tomorrow. It is whether a supermarket carrying that much debt can compete with rivals who do not spend hundreds of millions each year servicing loans they never needed. Then there is Morrisons, Britain's fourth largest supermarket, the Yorkshire grocer that used to be family-owned, stable, unremarkable in the best way. In October 2021, private equity firm Clayton Dubilier and Rice bought Morrisons for £7 billion. Another leveraged buyout. Another mountain of debt placed on a functioning business. By 2023, Morrisons carried £8.5 billion in debt. Interest payments alone cost £728 million that year, up 23% from the year before. The company reported a £1 billion loss. A supermarket profitable for generations suddenly bleeding money at an unthinkable rate. Morrisons sold assets. It sold its petrol forecourt business to Motor Fuel Group for £2.5 billion, keeping a 20% stake and using £1.8 billion to reduce debt. Even that was not enough. The company launched a £1 billion debt buyback program, trying to relieve the pressure. Debt to earnings hit 4.2 times at the start of 2024. Analysts consider anything above 3.5 times dangerous territory. Morrisons was drowning, and every rescue attempt highlighted how severe the problem had become. Unlike Asda, Morrisons appears to have stabilized somewhat. New chief executive Rami Baitier introduced a back-to-basics approach. Sales turned positive in mid-2024 after months of decline. But the debt remains, the interest payments remain, and the fundamental question remains: why should a profitable supermarket carry billions in debt simply because private equity wanted ownership? Iceland is different, family-owned, run by the Walker and Dhaliwal families, no private equity, but still deeply vulnerable. Iceland carries £800 million in bond debt. For a chain with around £4 billion in revenue, that is manageable in theory. But Iceland specializes in frozen food. Almost everything requires constant refrigeration. When energy prices surged in 2022 following the war in Ukraine, Iceland's costs exploded. Electricity bills more than doubled in fiscal 2023. Energy costs rose by £93.3 million in a single year. Iceland fell to a £17.1 million loss, widening sharply from the year before. Moody's downgraded Iceland's credit rating to B3, well below investment grade. Bonds maturing in March 2025 dropped below 80% of face value, a level typically considered distressed. Credit insurers withdrew cover for suppliers, meaning companies selling to Iceland could no longer insure against non-payment. Iceland fought back. It secured energy supply agreements covering most needs through 2024 and a portion beyond. It installed solar panels, upgraded refrigeration, cut marketing, and even canceled a Christmas advertisement to preserve cash. By 2025, Iceland stabilized. It refinanced debt, improved cash flow, expanded food warehouse stores, and reported volume growth. But the near collapse exposed the fragility. Iceland came within weeks of running out of money. Survival depended on speed and lender cooperation. Not everyone gets that chance. And then there is Poundland. In June 2025, Poundland was sold for £1. The chain that once sold everything for £1 was itself worth exactly £1. The buyer was Gordon Brothers, a firm specializing in distressed retailers. The acquisition happened days before insolvency. The restructuring was brutal. 68 stores closed, 2 distribution centers shut, frozen food logistics exited, around 1,000 jobs cut, online operations wound down, pricing simplified to £1, £2, £3. By December 2025, over 100 stores had closed. Twickenham, Westhoughton, Market Harborough, Rochdale, Leicester, Tenby, Blackpool, Carlisle, Peckham. Each closure meant lost jobs and empty units in communities reliant on cheap essentials. The closures continued. More in December, more in January and February 2026. Clearance sales advertised discounts of up to 40% as stock was liquidated. Official explanations blamed expansion into chilled and frozen foods, unsustainable online operations, rising wage, and national insurance costs. All true, but the deeper issue was simpler. Poundland abandoned the model that made it work. When costs rose and competition intensified, there was no buffer, only debt and losses until rescue arrived for £1. What connects all of this is not incompetence. It is structure. Private equity loaded Asda and Morrisons with debt. Iceland was exposed by energy shocks. Poundland overreached. But underneath it all lies the same truth. UK grocery retail operates on margins so thin that any shock can push even major chains toward crisis. And the shocks keep coming. Employer national insurance rose to 15%. The national living wage increased 6.7%. Energy remains expensive. Supply chains remain fragile. Discounters continue taking share with ruthless efficiency. Tesco and Sainsbury's have avoided the worst through scale and capital access. Even they are cutting jobs, closing counters, simplifying operations. The pressure is systemic. Walk through the reality. Waitrose closed its Enfield warehouse in summer 2024, affecting 545 jobs. Sainsbury's cut 3,000 roles in January 2026 despite record Christmas sales. Tesco cut 400 more. These are not failing companies. They are profitable businesses optimizing for higher margins by employing fewer people. Some chains will survive, others will not. The high street will continue shrinking and consolidating until only the biggest and cheapest remain. This is not a sudden collapse. It is a long, slow decline, and it is already underway.